Hello and welcome. I'm Jackie Lockie, your financial planning maestro. This series of podcasts is aimed at existing financial planning professionals, as well as those looking to enter the financial planning profession. This particular series of podcasts is focusing on financial planning businesses. We share new ideas and challenge your thought processes to help you improve your service to your clients. We have some amazing guests lined up, helping you look at things very differently. I hope that you enjoy today's podcast episode. Hello and welcome. I'm Jackie Lockie, your financial planning maestro. And in today's session, we have a technical focus session, and we're talking all things ESG and how, as financial planners, you can overlay ESG in the advice that you're giving, in the kind of questions that you're asking clients. And we all know that there's been lots of focus on ESG very recently. And so I've got an expert with me who's going to start chuckling in a minute, an old friend and an expert, and that is Sam Adams from Vert Asset Management. Welcome, Sam.
Hi, Jackie. Thanks for having me.
My pleasure. My pleasure. Now, the last time I saw you, you were going off from the UK, having worked at Dimensional for a number of years and delving in the world of ESG. And that was quite some time ago. We were just reminiscing, weren't we? 10 years plus?
Yeah, it was. We left the UK in 2013. So yeah, that was a long time ago now. Yeah, you're right. We left Dimensional to start a dedicated ESG investment management firm with the goal of helping, in particular, financial advisors do more sustainable investing. So it's pretty much what we've been working on full time since then. Wow.
So we are going to start at the very beginning and then very swiftly probably move on to some more of the technical aspects of ESG. And I'm just going to start firing off some questions because I have to confess that I am not the world's expert at ESG, as our listeners will know, having not practiced for a number of years myself. So Sam, you're going to probably think, oh, Jackie's asking me all these daft questions, but hopefully for those people who are new to the ESG market or who want to do more for their clients on this front, then these questions that I'm going to be firing at you are going to be helpful to them.
So, I love it. Let's go.
Okay. So let's start at the very beginning about ESG, because last year I attended 3 different webinars and 3 different fund managers said to me, this is, the next best thing since sliced bread, as they say. But the most important thing is out of ESG is E. And then the second fund manager said to me, well, it is S. And you can imagine what the third fund manager said to me. No word of a lie, I was like, well, by the end of that, 2 weeks after those 3 webinars, I didn't have a clue where I should be focusing my efforts. So just give us an overview of what ESG is and why these different fund managers saying, you should be focusing more on one aspect or another.
Yeah. Well, you said that's a great question, Jackie. And I'm glad you started with it because there's lots of ways to invest for sustainability, ESG being the most prominent one of them. But there's so many different terms that the industry uses interchangeably that it's even impossible to start a conversation on ESG without setting out what we're talking about. So let me back up even a little bit further and make a distinction between ESG, SRI, and impact. We think there's thousands of ways to invest for sustainability, but these terms are used interchangeably and it confuses people. So just for today's purposes, we'll use the terms that I use, but choose your own terms, but just be consistent with them. So ESG is looking at companies and adding on an analysis of that company's environmental footprint, how much natural resources they use, how much pollution they create, And that's the E side. On the S side, it's their interaction with their stakeholders. How good are their relationships with their employees, with their suppliers, with their customers, with the community, with the regulator? That's the S part. And then the G is, how are their controls, their risk controls in the way that they govern or they run their business? And so ESG, of the 35 trillion US dollars around the world that is invested in sustainability strategies, 90% of it is in ESG. That's what the big institutional investors do. 7 of the 10 largest pension funds invest in ESG, and they're really trying to improve the risk return characteristics of the portfolio through their ESG analysis. The SRI is what we used to call ethical investing, where you say, I don't like alcohol or tobacco or gambling or pornography or nuclear weapons or investing in South Africa or what have you. And that's where the financial advisor, the investor, has to tune the portfolio to the investor's particular characteristics, what they care about. Right. And that's very different than ESG, but they're often lumped together. And then thirdly, there's impact investing, which I like to call a for-profit version of philanthropy. And that's where you're saying, okay, I'm trying to solve a particular problem, dirty cook stoves in Africa. How do I do that? Do I send them a bunch of money, a charitable donation, or do I put my money into this for-profit company that's going to start distributing cook stoves and maintaining them and fixing that problem on a long-term basis, right? So it's using a for-profit model to fix a social or environmental problem. And that's usually private equity or private debt. Once we have those 3 categories set out, you can see that ESG is all about what the companies are going through as opposed to what the individual investor is trying to accomplish. And when you do that, you quickly start to realize that some companies, let's say a mining company or a construction company, have issues that are super important, like health and safety of their employees, right? Accident rates, those types of things. And other companies, say banks, have other things that are more important, like cybersecurity, right?
Yeah.
No one's getting physically, I hope no one's getting physically hurt in the bank, right?
Yeah.
So when one fund manager says E and one fund manager says S and another fund manager says G, sometimes it gives you a clue as to where they're investing, right? If you're investing in some types of companies, the environmental concerns will raise to the fore, and other types of companies, the social issues will come to the fore. But in most cases, they intersect. Let me give you an example. We have a global sustainable real estate fund. So we invest in buildings or the owners of buildings, companies like British Land. And they're trying to get their buildings to be more energy efficient, right? But at that same time, they're trying to make their buildings healthier for the occupants. And so a green building certification is a way to do both of those things. So that's E and S together. So ESG is confusing in that respect. But if we look back to materiality, what are the companies going through, it becomes clearer.
Yeah. Okay, that's great. And so that leaves me nicely on to a few things that have been bending my brain over the last few weeks. And the 2 issues are greenwashing and also the Bloomberg article that I was chatting to you about MSCI ratings. Because just run us through, first of all, before we get into the Bloomberg article, and I'll get back on my soapbox and then back off it again very swiftly. Let's talk about greenwashing, because I know that that word is used a lot in the profession, both really for, trying to identify firms and businesses that perhaps aren't doing everything that they should be, or maybe they are putting their efforts into things that are less important in the overall impact that they're having on the world at large, if you like.
Right. Yeah, I love the greenwashing criticism. You don't hear people say that a lot, but I love it. I love it for 2 main reasons. Before the greenwashing criticism really came to the fore of sustainable investing, of companies trying to be more sustainable, people a lot of investment management firms, a lot of investors just dismissed ESG. They just said, that's ridiculous. I'm not even going to consider it, right? But when they start listening and then they start criticizing it, you know that they're concerned about it coming along and taking their market share. And it's a real problem, right? I remember back when the index fund or passive revolution was happening, when they stopped ridiculing us and they started actually addressing, right?
Yes.
The fact that they had some competition. They said, oh yeah, indexing is great, but only in large caps, right? And then so when they start pointing out flaws to ESG, like greenwashing, that means they've tacitly accepted the fact that it's here and it's real and it's a mainstream part of the investment management creed. So that's one reason I like the greenwashing creed. The other one is because it's hilarious. I mean, are we really surprised that a company is trying to put its best foot forward and make itself look good in marketing brochures and presentations and on the earnings call, right?
Yeah.
I mean, that's what companies have always done. They're like, oh, don't worry about that problem. Look at this wonderful thing that we have here. And so when sustainability becomes important, of course, companies are going to do that. And even more ridiculous is the idea that we're surprised that the financial services industry is selling us a basket of goods, right? I mean, okay, a fund manager is telling us that we're going to get 5% outperformance, it's going to be lower risk, and we're going to save the polar bears. Are we really surprised that they're doing that? I mean, of course they're going to do that, right? So it all comes back to, caveat emptor, investor beware. You have to be on the lookout for that, and you should be expecting these things and say, yeah, they're just doing the same old thing. They're selling us something that isn't quite what it does on the tin. Not surprising.
And I guess that is just basic economics. If you were running a business, that's exactly what you would want to achieve. You want to achieve the best return for your shareholders. So that's why you put your best foot forward.
Yeah. And so it's no surprise that on the sustainability side, they have glossy brochures with smiling people and windmills in the background. And all. That's exactly what we would suspect. Now, in the early days, right, it was really easy for these companies to come across as green and socially responsible because they just needed to put out a brochure. I remember when we started our fund in 2017, if someone had a sustainability section on their website or a sustainability report, they were a leader. Now everybody has them. And when you look into the reports, you quickly see that those glossy pictures aren't doing it anymore. You need hard numbers, you need real commitments, you need proof of your performance. And so it's getting harder for people to skate by with some greenwashing, right? And the better tools that the researchers are providing us and the standard setters are providing us are just allowing us to see through the heroes and the zeros more quickly now.
Yes, yeah. And that leads me on nicely to talk about this Bloomberg article. For our listeners, I will put the link to the Bloomberg article in the show notes for you to have a look at as well. But it was basically focusing on ESG and focusing on the MSCI ratings. And I wanted to talk to you about the reference and the situation about McDonald's in that article. And it was basically saying that, McDonald's were fairly low down the ratings. They wanted to improve their ratings. They knew that the chances are that they were going to start being fined by the French and British governments because they needed to do more about recycling their cups. So they've put a few undisclosed number of cup recycling centres in some of the cafes and shops. And the MSCI index has improved their rating seemingly on the back of that, but probably, hopefully, other things, notwithstanding the fact that, their carbon footprint has gone up by 7% in the last 12 months because of all the beef that they're producing for obviously the masses of beef burgers. And it just seems, I guess this is one of those things where it's doing what the business needs to do in order to maximize shareholder return. And how much of it is actually focusing on where the big issues are.
Yeah, there's a lot. I love that article because it brought a lot of issues to light. And let's hit the last one that you said there. First and foremost, when MSCI and Sustainalytics and these companies are looking at companies through an ESG lens, they're really not trying to tell you what their impact on the world is. That's another frontier that we're starting on, but that's a hard ask. What they're really doing is telling the investor community what risks and opportunities the company is exposed to. So they're trying to get a sense of, McDonald's risk exposure to, the net zero transition, to carbon pricing, to supply chain issues, all those types of things. So they're trying to give you that perspective. So if there's criticism in there that says they're not really measuring the impact of the company on the world at large, I'm okay with that. There's other people who are doing that and working on that. But for these investment research analysts, I want to know from them how the company is doing with regards to their environmental footprint, their social footprint, et cetera. Now, when they do that, what I call ESG 1.0, what was in vogue from, say, the beginning of ESG, and which is only, remember, 15 years old. It's really started in 2005.
Yeah.
To about a couple of years ago was the ratings era. And MSCI and Sustainalytics would package up all the information. MSCI had 187 different variables at one point that they measured companies on ESG, and they would wrap that up into a single score, A, AAA, B, C, good or bad on one sustainability dimension. And while that was well-intentioned, it really doesn't get to provide you with much valuable information. And for financial advisors, I said, this is the line that I encourage them to use. Say, we use ESG ratings like we use the Morningstar star ratings. We don't, right? You can't take an entire investment opportunity and encapsulate it in a single letter grade or number grade. That just doesn't, you just lose too much information. It's not valuable. And so the ESG movement, the investors have most of them have caught on to that and said, okay, that's not valuable exercise anymore. Plus, MSCI's ratings don't match up with Sustainalytics, don't match up with Reuters, don't match up with the other ones. They don't agree. And this is because, when a researcher looks at 187 different variables and attaches different weights to them and then comes up with an overall score, that's their score. And someone else will look at different variables and attach different weights to them and come up with another score. And so you have these crazy scenarios where one researcher says Tesla is a sustainable company and the other one says it's a not sustainable company, right?
Yeah.
And so this is where we go back to that thing about materiality and say, don't measure every company on 187 variables. Look at what the company's risk profile is, right? If for example, I'll use another real estate example. If you're a building owner in the UK or in Europe, and you have some buildings that don't have their EPC, their energy performance certificates, up near the top, okay, you're at risk of not being able to rent those buildings. Building's going to have no revenue for you. All right. And that's a material risk to the real estate industry, right? Those regulations around carbon emissions. And so the health and safety of the air quality in their buildings is a material issue. Other things are not. And so the ratings era is swiftly passing, and you can the best argument I have for that is MSCI and Sustainalytics now give those away for free. Right. So you can look up on MSCI the rating on any stock, on any fund in the world for free, which tells you what the value of it is, right?
Yeah. And I think that's what drives financial planners potty, because you have all these ratings agencies and they're all saying, like you say, somebody's at the top, somebody else is saying they're at the bottom. And if you're trying to save time as a financial planner, what are the sorts of places you start? Because I guess, we've got quite a lot of planners in the UK and wealth managers who are discretionary fund managers, so can make those kinds of decisions as far as investment goes. And the client comes along and says, oh, well, I've seen this investment, or I quite like this. How do you start to overlay those kinds of conversations with picking relevant funds?
Well, before I answer that, I want to just point the listeners to a wonderful paper that nails the ratings problem. It's called Aggregate Confusion. And just in the title, you can tell what the paper is about, but it really breaks down that ratings problem. So if you're interested in getting into the weeds into that, it's a fantastic paper. Aggregate Confusion is what it's called.
Thank you.
But when we started our company, we really wanted to be a resource for financial advisors because the landscape around sustainable investing was so confusing. And there weren't very many resources. That has changed now. I mean, everyone's gotten on the ESG bandwagon. Almost every fund manager has investment products in the ESG dimension. Some of them have training programs. Not a lot of them are very good, but there are options for advisors to get started. Here's a couple of things that we're doing just to give you some examples. So I wrote a book with Larry Swedroe. It's called Your Essential Guide to Sustainable Investing, and it comes out next month, actually. It's a UK publisher, Harriman House, and it's available for pre-order on the Amazon and at Harriman House. And we're letting advisors buy copies in bulk with significant discounts so they can hand them out to their clients and say, this is what we think about sustainable investing. And it's a very evidence-based approach, examining performance and not doing that greenwashing thing that we talked about earlier, right? Really giving you the straight scoop. So that's a helpful resource. We run courses as well. We have a series of boot camps that help advisors get started in sustainable investing. And you can find those at verteducation.com. There's a couple of UK ones coming up. I think the next one is in August 2nd, I believe. And so we have those resources. There's certainly certification programs you can take. I'm not up to speed at all the ones in the UK. I'm sure you are, Jackie. But we teach a couple of those courses here in the US as well. And then organizations like Morningstar have excellent resources on their website. I follow John Hale. He's their director of sustainability. And there's just a wonderful blog that he has. And by following that, you can really get up to speed on what the sustainable investing universe is going through.
Okay, I think I better start doing that because I need to catch up a little. So let's talk about some of the nuggets of irritations that financial planners have told me about. And the first thing is, two things. I'm sure you're going to love these two subjects. They are MiFID. MiFID 2, and also the international reporting standards. And what financial planners have been saying to me about MiFID is that it drives them a bit dotty. So how does even ESG and the things, the questions that you have to go through with clients and the answers that they give, how does that colour your conversation around MiFID and perhaps how it's dealt with?
Yeah, I mean, I love the fact that ESG revolution is paralleling the passive and fee-based revolution. Almost like the parallels are amazing in their similarity. And I remember, I was working in the UK, but also doing work in Australia and the US. And Australia banned commissions, and then UK banned commissions, and the US never did. But we all got to the same place where fee-based advice is now the standard all around the world, right?
Yeah.
And sometimes regulation can help. Sometimes it slows things down. It's hard to say, right? But I think either the market forces, right, are going to propel, and because when you look at the surveys, something like 80% of individual investors, when asked, say they're interested in a sustainable investment solution. Well, I don't think you need regulation to tell people the people are going to eventually start asking their financial advisor. But the regulation might be good. Like, why not ask that question? I don't think it's that onerous, right? I mean, any tick box exercise is onerous, but if you just have to add upon your discovery process a couple of questions, are you interested in sustainable investing? And if the client says, Yes, I am. Let me hear more about that. You just set out your stall and say, hey, this is what we do. We have a set of conventional portfolios. We have a set of ESG portfolios. You can choose between the two. If you want any more customization than that, please go down the street to somebody else. We don't do that. Or bring that into your suite of services. It's up to you as an advisor. But know that by 2025, maybe at the latest 2030, all investment advisors and investment houses will have ESG offerings and ESG solutions. This is not a fad. This is not going away. You're going to have to wrap it into your services at some point. Right now, you have an opportunity to be a thought leader. So why not do it now rather than wait for later?
Yeah, definitely. And I think that's, some of the planners that I've spoken to, that's where they start to worry, because you put something on a form and it's kind of a bit like having those conversations that we had all those years ago when fee-based financial planning came to the UK, and you say to a client, do you have any ethical worries, or would you like to invest sustainably? And the client says, well, yeah, I would actually. And I will tell you a funny story. When I was young, many moons ago, and I was advising, a client called me and said, Jackie, must have a meeting, urgent meeting. I'm going to come in this afternoon. I was like, oh, okay. Anyway, he came into the office and he said to me, Jackie, as you know, I'm a devout Muslim, but I have won £50,000 on the national lottery.
Wow.
Which is against my religion.
Oh.
And because you're not allowed to gamble. And he said that, I should hand it over to the elders, but I don't want to. I want to invest it quietly and privately for the private education of my 2 young daughters. So I was like, okay.
Wow.
So he then said to me, but I would like it to be invested in line with my religious beliefs. So nothing to do with alcohol or gambling or armaments for other countries and things like that. So who do I write the check to? And I was like,
So that is a hilarious story, because that's ethical investing on a whole nother level, right? There's several layers in there.
Yeah. Well, it was very hard to sort it out.
Oh, yeah. And this is one of the advisors' main reluctances to do sustainable investing, which I totally understand, because usually the experience that they've had might not as extreme as the one you had, is the investor that does ask or has asked in the past has been someone with very specific issues. They want SRI or ethical investing, like your Muslim client, who said, this is what I need. And it's very specific. And then it's the advisor's job to go find something that's tailor-made or custom. And it's hard to do with the typical investment products. But here's why that framework that I talked about earlier between ESG, SRI, and impact is very important. An ESG strategy is not customized to the end client. The ESG strategy is using evidence from the markets to choose companies that are doing better or more poorly with regards to the environment, to their social and their governance issues. That's not really, the investor doesn't weigh in on that as much. The SRI or ethical portfolio is, I'm Muslim, I'm Catholic, I have these issues, I want to tune my portfolio to that. And so if you have that framework, you can, as a financial advisor firm, say, we don't do SRI or ethical, you'll have to go somewhere else. Or we have these set of ESG model portfolios, you can take that, but it's not really fully customized to you. Or like I said before, you can, at whatever client level you can do that at, do a custom portfolio for them. But I think understanding that difference, and let me just point out that when the Church of England, when the Norwegian pension fund, the Japanese pension fund, the California pension fund, when they're investing for ESG, they're not tuning the portfolio to their constituents' needs, right? That's not, they have one giant portfolio that's, right? And so ESG is something everyone can do. And then you'll have to decide whether SRIs. But know this is the critical point. 80% of the clients that are coming into your office are not asking for an ethical or SRI portfolio. they'd like a sustainable portfolio, which is they know that their money is not doing as much harm as it possibly could be doing. Maybe it's doing a little bit better, right? That's really where they're trying to get to.
Yeah, yeah. And that's really interesting, isn't it? I think that's the critical place to start, as you say, defining in your business as a financial planner what you mean by ESG, what you mean by SRI, and what you mean by impact investing, and then what portfolios you offer or where you recommend clients go on the back of those three decisions.
Yeah. And I mean, think about this. My wife and I have been investing sustainably for over 10 years now, and in our personal portfolio. And our financial advisor about 8 years ago came to us and said, "Hey, would you like a separately managed account where we tune the portfolio to your specific beliefs around, issues around gender equality and animal rights and abortion and those types of things?" And we're like, no. We want professional fund managers to make the decisions about what's most important for the companies they're investing in and them to make those decisions. We don't want to be saying, "Oh, don't invest in this or do invest in that." And we study sustainability full time, right? And so that's why I'm saying that a lot of investors will let me give you an analogy. We buy organic food at the grocery store. I'm not looking through the labels all the time and checking whether it's grass fed, whether it had, whether the cow was massaged as well, and whether it was free range and all that. I'm like, okay, the organic certification is enough for me. If you give me an ESG mutual fund, we'll have to get advice from my advisor on which one's better than the other. But I'm happy with it just being a sustainable alternative to the conventional.
Yeah, yeah.
Most clients are like that.
That makes sense. That makes a lot of sense, actually. I like the organic label description. I think that's fantastic. And I think one of the other specifics that I know another financial planner who lives in this house has a bit of a bugbear about is this going up and down the carbon footprint chain and trying to offset as much as you can. Where does the business start and stop as far as going up the chain? So if you have a fund manager who says, I'm going to invest ethically in my fund, and I'm going for carbon offset. I think a couple of years ago, I was talking to a fund manager who's doing this, and there was much detail and much emphasis put on looking up and down the chain of the individual companies that they buy to see, or trying to ensure that as much as possible of their carbon footprint of those businesses they were buying was actually offset. And is that, because you can never really do all of that, can you?
No, you can't. And so the offsets, and it comes, the immediate response I have to offsets is greenwashing, right? That's where I go. If someone's talking a lot about offsets, I want to know very quickly whether they're greenwashing or not, because that's a lot of offsets are used for that. So here's where offsets should be used. They're the very, very, very last resort. So if you have taken your business and you have reduced all the energy use that you can, which means you spent 5, 8, 10 years, replacing equipment, really working on your processes and doing all those things. And you've reduced your greenhouse gas emissions by 80%. And you've improved your relationships with all your stakeholders. And you've done all this stuff. And then at the end, you're just like, okay, we're as low carbon as we can get. Then you can look at some offsets. But if you have, like, for example, this fund manager, a portfolio of a bunch of assets, and they're not obviously net zero, okay, the idea that you can offset enough to get those there, that's just not possible, right? And so offsets should be considered a last resort. Now, what I guess Robert's concerned about that carbon accounting is a real challenge, right? We need to start with the whole life cycle of a company and saying, okay, what is the carbon footprint of everything from the extraction of the natural resources to your production, and construction, and then manufacturing and distribution, and then the end of use and by the client, and then the recycling of it. Like, what is that entire life cycle? And know where the carbon emissions come from and all of that. And only after that can we then apportion responsibility. My analogy is VAT, right? We're going to charge it. We need to know the whole thing, right? And then we can apportion responsibility after the fact. But without understanding the emissions at every level, okay, we're going to have ridiculous things coming up like we do now. With ExxonMobil is saying they're going to be net zero by 2030, right? Well, that doesn't make any sense.
No. Yeah, it's all a bit strange, isn't it? I think, and this is, maybe this is where as financial planners, heads start to spin, because you can dive into kind of too much detail, can't you, with this? And like you say, if you're looking for that organic label in the supermarket, then, you've got to decide yourself as a firm, if you're giving advice to clients, what your methodology is, what your philosophy, your investment philosophy is, as far as, ESG, SRI and impact investing goes, don't you? I mean, without any of that, you're just chasing your tail round and round in circles, trying to build things to all men. Yeah.
I mean, it's definitely a challenge, but here's the exciting part for me. This is the brightest silver lining here ever, right? Well, and again, I'll do that analogy because I know you have a lot of evidence-based listeners, to passive and fee-based. When you had to move from commission to fees, that was a difficult thing to sort out for your business. And it was a really hard conversation with clients and saying, hey, remember it looked like we never charged you? Now we're going to start charging this explicit fee. That's tough. That thing we used to talk about a lot, active managers and how they're all great. Well, they all suck, it turns out. And now we're going to index, right? That was a difficult conversation. None of your clients wanted either one of those conversations. They didn't ask for it, right? No. This, again, is a difficult transition. But the main difference is your clients want it, right? People want sustainable investment options. They want to move their lives to be more sustainable. Most people do. They're looking around and they're hearing from the environmentalists, you drive too much, you fly too much, you eat too much red meat, put down that plastic, we're tired of it. And we look around for solutions and the solutions really aren't there. There's, I can't afford an EV, or I can't stop flying, or I am not ready to be a vegan, and so then your financial advisor comes along and says, hey, this big part of your human capital, your financial capital, we can turn that from the problem category to the solution category. We're going to move to some ESG mutual funds and ETFs. And what we're going to do is start emphasizing the companies that are doing better and de-emphasizing the companies that are doing worse. It's not going to save all the polar bears, right? But it's pushing companies to do better. That is wonderful news for your client. My financial advisor who helped me do this 10 years ago, I still think he's an absolute hero, right? Yeah. And so financial advisors have this once in a lifetime opportunity to be out on the front foot on leading this and giving their clients something that they actually want. And let's face it, usually when a client of a financial advisor asks for something, they're not asking for something very good for them, right? It's usually a hedge fund or Bitcoin or something like that, right?
Yes.
This is actually something you can do for them.
Yeah, absolutely. Yeah. And it's just about setting your stall out. And, I've heard that there are lots of organizations like the Net Zero Asset Manager Alliance, all sorts of different things, looking to create ratings, looking to put out data. What would you say to financial planners who are kind of getting started or trying to get established in this field? Because I think, like we were just saying earlier, this just seems to me that there is so many rabbit holes that you could dive down and never be seen again, essentially. Where do you stand on all this with so many different alliances and reports and analysis coming out?
Well, I'll point listeners to a really interesting resource from the World Economic Forum. It's called the ESG ecosystem. If you Google World Economic Forum ESG ecosystem, you're going to see this wheel that pops up that has the framework builders, the standard setters, the accountants, the assurers, the research providers, this wheel of providers that are working on ESG. When you see that and you click through it, and it's an interactive tool, you realize that the entire world is moving in this direction. Capitalism is changing, right? What we're doing is we're starting to price things that we called externalities that didn't have prices. We have to put prices on things like clean air, health and safety, well-being, carbon, so that capitalism integrates these prices and starts allocating resources to good things and away from bad things. Because without those prices, the market's not allocating correctly, right?
Yeah.
And so that, I think, is the solution to our climate challenge. It's a solution to a lot of justice and fairness issues and inequality. It's a solution for a lot of things. And it's amazing how many people are working on this. Now, we're not at the point where any of these standards or ESG frameworks are like what we're used to in the financial world. But I want to give a little bit of a history lesson. Back, over 50 years ago, when I saw a revenue or a turnover number or an earnings number from a company, I couldn't trust it. I couldn't compare it to another one because it wasn't standardized. The company was just saying whatever they wanted to say. And then FASB, the Financial Accounting Standards Board, standardized that number and it became comparable. I can compare the turnover of this company to that company. We're getting there with the ESG stuff. Let me compare the greenhouse gas emissions of this company to that company. The UK was a leader in this in 2012, passing legislation that required all companies listed on the London Stock Exchange to report their greenhouse gas emissions as part of the financial reporting package. Now it's a much more standardized figure. This whole effort means that sustainability, ESG factors will be part of the normal reporting package, will be part of the normal data sets, will be part of capitalism in general. And so companies will have to start managing those issues. So you brought up the Net Zero Asset Managers Alliance, which we are a signatory to. And this is an incredible statistic. 236 managers are signed up for it, representing $57 trillion around the world. That's a lot of money.
It sure
and
is.
If you're wondering, Vert Asset Management, we're, a bunch of peers of ours, little guys like BlackRock and Vanguard and Legal & General and Fidelity and Schroders.
Yeah.
I mean, literally, UBS, right? HSBC, like they're all in here. And what they're saying, what they've agreed to with this pledge is they've said, okay, we're going to get all of our investments across our portfolios to be on a net zero pathway by 2050. So we need to convince the companies that we're investing in to get ready for that. And we also have to convince our clients, the asset owners that we're investing on behalf of, to come along with that ride. And I just love that looking up to the investors and then looking down to the companies and saying, hey, we got to push in both directions. And now you look at public companies and you're saying, wow, the regulator, the investors, their suppliers, their peers, their competition, everyone's pushing to decarbonize the economy. So I have a lot of high hopes that we're going to make some progress quite rapidly.
Yeah. Yeah, well, that sounds amazing, and I'm sure we'll be keeping abreast of the developments across the world that happens with the alliance. And there's another one, the World Benchmarking Alliance. Do you know much about that? Is this a kind of similar thing, or is this doing something different?
I think it's slightly different. I like to make a distinction. Probably isn't as black and white as I'd like it to be, but there's NGOs and nonprofits and other and for-profit researchers that are looking at that impact piece, right? How are these companies impacting their societies, their communities, the local environment? And then there's the investment guys that are saying, okay, what's the impact to the companies? And there's a lot of crossover there, but the World Benchmarking Alliance is trying to figure out how companies are doing with regards to the Sustainable Development Goals. Are you helping stamp out poverty? Are you helping, get air cleaner? Those types of things.
Yeah.
And so I love those processes because the more information that we have, the better we can make decisions with. And this benchmarking idea, which is effectively naming and shaming, let's name the heroes and let's, the leaders and let's name the laggards, will put pressure on companies. There's another wonderful academic paper called Can Sustainable Investing Save the World? Another great title.
Is that a really short one or a really long answer?
It's a long answer because it's an academic, peer-reviewed paper, but it has a nice pithy title, which I like. But it does break down the three mechanisms for how sustainable investing will change the world. And one is capital flows. If more money goes to companies that are more sustainable, they'll have lower cost of capital, right? The second one is engagement. This is what my co-founder and wife, Sarah, leads on in our company. She's our chief sustainability officer, and she talks to all the companies in our portfolio every year and encourages them to adopt the next sustainability framework, the next standard reporting, pushing along them. So a lot of sustainable investors do that. They encourage companies to be more sustainable. The third way, which is they call an indirect way, but might be one of the strongest ways, is this benchmarking, this naming and shaming, right? If Volkswagen hears that BMW is higher on the league table around sustainability, right, they're going to be like, I want to beat BMW, right? Yeah. If Coca-Cola and Pepsi are battling it out, or if you're the CEO of a public company, you realize that you're in the bottom quartile of companies, Greenpeace's list, or the World Benchmarking Alliance's list, or the Economist's list, or Dow Jones's list, you're going to be like, we need to change that. That's bad PR. That's going to affect our suppliers or our clients, that type of thing. So the more of those things, the better, as far as I'm concerned.
And do you think that those things will turn into usable tools for financial planners?
Well, that's why I make a distinction between the ones that are just talking about the companies and the funds, right, and focused on the investor issues, and then the ones that are talking about more general societal impacts and those types of things. I think both are important. But remember, with a financial advisor, you're a fiduciary, or hopefully you are, and you're looking after your client's best interest. And your job is to maximize their financial returns for a given level of risk. And you can consider sustainability in that because it might help that as well. But you can't throw that out. That has to be the case. So we will need tools from the financial services and investment management industry that can push that along. Now, you'll get crossover where something that someone discovers in the nonprofit world or the NGO world or the research world will say, oh, this informs the investment case. And for a good example of that is Drawdown, a Paul Hawken book, which is probably my favorite book of all time, the 100 Best Solutions for Climate Change. That research done can then then companies can realize wow, one of the best things we can do to reverse the effects of global warming is to capture the refrigerants when we dispose of our refrigerators or our air conditioners or those types of things, right? Something we didn't even realize was as big of an issue as it was, right? Yeah. Like that's bigger than doing renewable energy at this point in time, right? So there's those types of things can inform.
Yeah, that's fascinating stuff. And we are so nearly out of time, Sam, already. So I just wanted to wrap up by asking you one final question, just to highlight from your point of view for all of the financial planners who are listening, particularly those who are evidence-based, what would be your top tips for them to get themselves organised to be as clear as possible in the service that they're going to offer to their clients?
Well, we say to financial advisors, you need to do three things. One, you need a sustainable investment solution, right? This is the time has passed for you to be able to say, I'm not going to do that, right? Yeah. So have one. Second, get your communications straight. And so have a way to sit down with your clients and ask that discovery meeting and then explain what you mean by sustainable investing. And for us, that's being able to distinguish between ESG, SRI, and impact, and then saying what you do and what you don't do. Make sure your entire team is on board with those terminologies, and be consistent around that. And then three, figure out how that your investment philosophy and your sustainable investment philosophy are congruent, and they should be completely congruent. And so that will inform how you do outreach, how do you grow your business, how you present yourself out there and say, this is where sustainable investing fits into our business and into our investment philosophy. we've structured our boot camps, our education courses around that framework, getting the investment piece right, getting the communications right, and getting the growth and marketing of your business right around sustainability. But we are by no means the only solution. I'm on the board of EBI portfolios. And we have a solution for advisors in ESG there. There's a couple other options in the UK, I know. But I would say the critical thing is to get started now rather than later. This is the greatest opportunity, I think, for advisors to grow their businesses. And it's also what your clients want. Yes. And so it's just, I can't really, other than it's going to be a little bit hard in the early goings, I can't think of a reason to not do it.
Just give them what they want.
Exactly. Well, don't give them exactly what they want. They're gonna, they'll probably be a Bitcoin ask in there. So,
Okay, well, nearly what they want then. Excellent. Sam, it's been an absolute pleasure to talk to you. Thank you very much for taking the time to talk to us today.
Thank you, Jackie. I really enjoyed the conversation.
I hope you enjoyed today's podcast. It's really interesting, isn't it, to listen to other people's points of view about different things, all relating to our wonderful financial planning profession. If you know anyone who might be interested in listening to any of these podcasts, please pass on our details to them. So that's it from me. Join me again next time when we'll be talking all things certified financial planner related and also dropping in on our new entrants to the financial planning profession. Bye for now.